Hey traders, this is Blake Morrow with Forex Analytics, and you're listening to the week ahead video for January 1st, 2023. Happy New Year. And I want to sincerely thank you from the Forex Analytics team. Thanks for listening to our week ahead videos every week and for the last 6-7 years that we've been doing these with the Forex Analytics brand. I want to thank you for making our community a special community, and I wish you all the best, health and happiness and prosperity in 2023. All right, now we're going to talk about this next week because this next week is going to be a busy week. I know we have a shortened week as Monday is a bank holiday. Therefore, we will not be broadcasting our normal F.A.C.E shows. So if you listen to like the Flow show, the F.A.C.E show throughout the course of the week, we will not be broadcasting on Monday, which will be the 2nd, but we will resume broadcasting on the 3rd on Tuesday, and that's when the rest of the market's going to be coming back anyway. But in the meantime, while you're waiting for us to stop broadcasting, make sure you start broadcasting. Make sure you check out Forex Analytics. It's only $1 for 10 days. Try it out and download the mobile app while you're at it. And also go check out the Trader Funding Program. The Trader Funding Program is how you can learn how to trade our money and not have to risk your own money. So it's a great way to go about it. You can find it right on the link down below in the description below. But, we're going to talk about, the end of the year. And the end of the year, as we expected, liquidity got pretty poor. But you know what didn't come to fruition that we were expecting is a Santa Claus rally. Now, we did get that rally at the very end of the session on Friday, the 30th. We saw this rally in the S&P, and we saw it at the end of the day. But that's not much of a rally. If you go back to a couple weeks ago before the Christmas holiday, we were looking for a little bit of a dip in the S&P down towards the 618, or maybe where we were at, and for us to rally back towards the breakdown point that you see here. That didn't come to fruition. What we did is we just got a lot of consolidation, and the one thing that I think you have to pay attention to is that we do have a pretty tight consolidation going into this next week. Now, I would expect that we might see a further move higher in the equity markets when we come back next week, as the market's still going to be fairly illiquid. Even though most participants are going to be back in front of their computers, there's a lot of planning, there's a lot of strategizing that happens right at the end of the year and right at the beginning of the next year. So I would think liquidity is kind of poor for at least the first few days of trading. So because of that, we might see a drift higher in equities. But remember, we do have some pretty key data coming out this next week. We do have the jobs report, not only in the US, but we also have it in Canada. And all the data that's coming up ahead of that, like the ISM data, the JOLTS, jobs openings. We also even have the FOMC meeting minutes next week as well. So there's going to be a lot of information, or a lot of data that's coming out into this next week. So make sure you're paying attention to that. One of the other things that you're going to get next week is you're going to get the Eurozone CPI data, which will be out on Friday morning ahead of the jobs report in the U.S. and Canada, and that could potentially be a market mover. Let's talk a little bit about currencies and what we've seen here. The euro continued to stay really strong. We closed near its highs, and we talked quite a bit last week on the F.A.C.E show, on our live F.A.C.E show. Remember, we do analysis throughout the course of the week, and it's not just myself, it's the rest of the team. As long as we're holding above 105.80, the risk was that we're going to continue to move higher. And you can see that the euro did base, and that move is trying to continue. We might see some continued dollar weakness until some of the key data comes out the middle of next week. Now, if you look at like the flag formations that have formed, I didn't mean to do that. Let me go ahead and clone that. If you look at the potential targets for the euro, depending on how you draw your flag patterns, whether you draw it like this or from the other low, the two targets are higher than where we're currently at. I mean, that could take us all the way to 108, 107.50, and maybe even as high as closer to 110. So it looks to me that we will see at least continued dollar weakness as we go into this next week. Now, you have to think about that too, and what could propel this move going into the next week is the jobs data. If we start to see some weakness in the U.S. employment picture, we're expected to create 200,000 jobs, but let's say the U.S. doesn't create or creates maybe 100,000 jobs. And remember, we have a lot of seasonal hiring going on right now too, but let's say the U.S. economy doesn't create any jobs in the month of December. That's going to weigh heavily on the dollar, and that's going to propel that euro up towards that 110 level. So that's something that we need to also think about. If you take a look at the sterling's also holding above the 200-day moving average. It's been kind of hugging it, but the pullbacks have been very minor. If you actually look at just this most recent leg higher in the sterling, you'll notice that we came really close to the 38% retracement, and because we weren't able to pull back below the 119.50 level. I know it says 119.65, but I really been focused on 119.50 all week. If you are in the Forex Analytics community, you already knew that. As long as we're holding above that, maybe the sterling gets back up towards 122, 123, maybe back up to this 120, 320 level, which is a really key level of resistance on the way up. Maybe we get back up there. If dollar weakness continues to bleed into the market, we see the euro drift higher. I would expect that the sterling gets pulled up, even if it's by its pigtails. It's getting dragged higher alongside the euro. But you look at the dollar yen. The dollar yen closed on its lows of the week, and it really looks like a pretty bearish formation. And if you just look at where this move started, way back here in March, this really big move. I know a lot of you are very well aware when that move started. The 618 retracement, or the key Fibonacci level, is down here at 128.80, basically 129. So if we break through this, support zone, we could very easily test these levels. Now, remember, I'm looking at the euro not with the lens, in a lens that the euro has further to go, but not a lot further to go. I mean, maybe 108, 110 before we start to pull back. Well, that could mean that the dollar yen trading at 131 could very easily trade back down to 129. It's a 200 pip move. If we get a universal move in the dollar index, that is entirely possible. You take a look at the Aussie dollar. The Aussie failed breakdown below this channel support. So, because of that, the Aussie actually looks relatively well bid. I mean, I know we had this inverted head and shoulder pattern that completed, but why can't we revisit the 200-day moving average once again? And if you take a look at the Kiwi pullbacks have been very minor despite that little false breakout. So, we've held above the 200-day moving average here. You could probably argue that's, a 24% retracement of this move, maybe? Yeah, it's about a 24% retracement, maybe a little bit more. That's a fairly shallow pullback for an asset that could be, construed as quite bullish. I mean, so why couldn't we revisit, some of this resistance zone up here? I'd venture to guess, let me see here, that's about a 50% retracement from this high that we had back in early in 2021. We're at the 50% retracement right now. Whoops, let me go ahead and leave that. We're at the 50% retracement right now. We could probably see a little bit higher than that. I would venture to guess, especially if the dollar does have some continued weakness around the market. And if you take a look at the dollar Canadian has really held up very, very well. But in the event that the dollar starts to bleed lower against the euro, the sterling, the Aussie, the Kiwi, the yen, what's to say that the dollar Canadian, doesn't break back below this descending trend line, especially after holding that 618 retracement. You can see that 618 retracement right here was very, very, very useful in capping the market. So, that's a key fib level that held. And while that holds, the risk might be that we slide through this trend line support. So you got to think about that. Now, what would accompany the dollar index lower? And matter of fact, I'm going to come to the dollar index because there is a little bit of a risk here to being short. So I'm going to get to that 1 second. But if the dollar continues to slide, that would complement the S&P, just going back to the S&P, that would complement the S&P to breaking higher and possibly re-challenging this 3,900 level. It's 39.10. Depending on if you're looking at the cash market, the futures market, depending on a CFD, depends what you're looking at. And if you trade, through the trader funding program, for example, you're trading through CFDs, right? So if you're accessing our money and you're trading through our accounts, you would be trading in a CFD type of environment. So the level you're looking at right here might be slightly different than if you're trading futures, but this is very critical resistance, previous resistance, current support, now current resistance, or previous support, previous resistance, previous support, current resistance, blah. That's what I meant to say. So if we get back above 3,900, why couldn't we revisit the 200-day moving average? I think that this could be a very doable target for the S&P. You know what else is actually holding up fairly well? What else is holding up fairly well is, gold and silver. If you look at gold, one of my colleagues has pointed out that this might be a wedge, which it could very easily be a wedge. But just because we're in a wedge, we're in an ascending wedge higher, doesn't mean it will break lower. Although the risk is higher that we break lower, that doesn't necessarily mean that is what will transpire. We could see a surge back above that wedge resistance, and I know there's a lot of gold bulls out there, and we could end up forming some sort of ascending channel. So we could very easily be trading closer to 1900 rather than selling off again and revisiting the 200-day moving average here. But gold's holding up. Silver also is holding up pretty well, and you can see silver has been really challenging previous support. It's been acting as current resistance. Another wedge. Also, we just saw that in gold. Well, guess what? Silver's got a very similar wedge as well. But that doesn't mean that will, there's a 100% chance of a reversal, even though this is a really good reversal pattern. That doesn't necessarily mean that's what's going to transpire. One of the other things that I wanted to focus on really quick is I want to take a look at the bond market. If you take a look at the bond market, the one thing about the bond market that we've seen is we've seen it complete a bear flag pattern. So it completed a bear flag pattern. We're holding the 50% retracement. Let's zoom in a little bit on the bond market. Notice how we had a false breakdown here right at the end of the week. Well, if the bond market has finished this ascending wedge and it's finished going lower, maybe it will bounce. And if it bounces, what does that mean? If the bond market is bouncing, that means yields are coming down. So that would also suggest that the dollar is coming down. If yields are coming down, the dollar is probably coming down a little bit as well. Now, before you get too bearish the dollar, because everything that I've showed you today really suggests that the dollar should break down. Let's go to the dollar index. One of the things that I want you guys to really pay attention to this week is the dollar index as we sell off, because we are approaching, let me just show you this last fib level here. That low right there where we had horizontal support and the push to new highs for the year back in September, we're at the 161% extension, or very close to the 161% extension of that. Now, that is the golden fib level. Okay, that's the golden fib level, and that is a really key level support. So I know everything that I showed you today is pointing towards dollar weakness. And it looks like, based on this chart, that we're probably going to continue lower as well. But what if this support holds on a push into new lows? If it does, and we see the dollar hold, some of the things that I was just showing you, we might see some reversals. We might actually see equity sell off. We might actually see gold reverse into those wedges. And we could actually see the dollar really start to firm up and move the other direction if we bounce off this 161% extension. That would mean that the euro comes down, sterling comes down, maybe even the dollar yen starts to show some sort of a bounce. But that's what I'm thinking with the dollar. That's why before I get too terribly bearish the dollar, I need to see how we react down here. Now, also, before I show you one last thing in the dollar, I just want to say, if you enjoy these week ahead videos and you think that they are helping you each and every week, make sure you give me a thumbs up. make sure you give some comments down below. It helps the YouTube algorithms when you jump in the comments and say hello. Also, my team would really appreciate it as well. We're working on the holiday weekend to get this video in your hands. So, as a thank you, just give us the thumbs up. We'd appreciate it, and share it if you see us on social media as well. All right, now last thing I want to point out with the dollar. This blue line is significant, and you're probably asking, well, Blake, why is it so significant? Well, it is the previous high from the post-COVID lockdown highs. So that is why this 161% extension of this last move and that blue line is so vitally important for the dollar. Now, if we break below that level, there's a risk that the dollar could really start to see a slide, and we could see, maybe much higher prices in the equity markets to start the year. But if you guys remember what happened last year, the equity markets actually reversed pretty hard on day one. I don't know if this is going to be necessarily a repeat. However, that is something to also keep in mind. Anyway, my name is Blake Morrow. I want to wish you all a happy new year. Here's to a good 2023. We're going to have a lot of volatility this year, and I'm going to be with you each and every week and each and every day on the daily shows, whether it's the Flow Show or the F.A.C.E show or the Daily Roundup, whatever you guys are watching. You'll see me there, and I'll be with you to navigate through this volatility that we're going to see in 2023. There's no better place to be than in the currency market, and there's no other better place to be than with the Forex Analytics community. So, guys and gals, my name is Blake Morrow. I want to thank you for being with me today. Happy New Year. I'll catch you on Tuesday, the 3rd. Hey traders, this is Blake Morrow with Forex Analytics. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.